So let's just dig into a little bit more detail around the tax rates and contribution limits, and hopefully this answers some of your questions. So the key thing is making sure that it is of benefit to salary sacrifice. So we've got an example here of someone who earns $44,000 of income, and that means that they earn between $37,000 and $80,000. So their marginal tax rate, when you include the Medicare levy, is 34.5%. So in this scenario, if the tax-free threshold is $20,500, we could salary sacrifice right down to that threshold and get an advantage. So the idea is that we take our $44,000. Of that $44,000, we direct $23,500 of it to our superannuation prior to paying tax. There's 15% tax payable on the way into superannuation, but we've saved paying 34.5% tax on that money. And our taxable income ends up being $20,500, so we'll pay no income tax, and we've saved nearly $3,000 in tax by doing that. There's an example of, only salary sacrificing down to the $20,500. And Fiona, this is trying to explain how far you could go down. Don't go down below that figure is the general rule of thumb. So if your taxable income's around $20,500, you're sort of optimizing your situation. But if your income is a bit higher than this, then you need to make sure that you don't exceed your concessional contribution limit that we talked about earlier. Lucy just asked about what about self-employed, similar to Calvin's question earlier. It is a similar thing when you're self-employed. What you do is you can put into your superannuation account. If you're a self-employed person, you can put into your super account a contribution of $35,000 and claim a deduction on it. That's what this is. So the concessional contribution limit is $35,000, but it includes superannuation guarantee contributions and salary sacrifice, but also personal deductible contributions. So if you are a self-employed person, rather than salary sacrifice or superannuation guarantee, the 9.5% that employees get, you can put in your own contributions to super, and the key is that you claim a deduction on it. So to satisfy this rule, you need to have no more than 10% of your total income being generated from employment purposes, and then you're eligible to make those personal deductible contributions. It's exactly the same sort of principle, but you just do it a slightly different way. You put your contribution into super, you claim a deduction on it, and then it has the same impact as salary sacrificing. So it's not that different, Lucy and Kelvin. But the point for this slide here is that you shouldn't go over your contribution limit. Let's say your income, for example, was $115,000. Our contribution limit is $35,000. Now, some people say, well, that means I can take $80,000 income into my hand, and then I can put $35,000 into my super fund. But what that doesn't factor in is that the contribution limit of $35,000 includes your superannuation guarantee of 9.5%. So in this scenario, you would have exceeded it by your superannuation guarantee amount, so 9.5 times $115,000, and you would pay a penalty on that amount. So just make sure that you understand that the superannuation guarantee is included within the $35,000 contribution limit if you're over 50, or if you're under 50, this is a $30,000 contribution limit. So make sure you don't exceed your contribution limit. Jerry says, how was $20,500 tax-free arrived at? Yeah, good question. Maybe I'll just backtrack on the slides here. So the $20,500, you're probably thinking, well, the tax-free threshold is $18,200, but there is what we call a low-income tax offset. So if you earn income of up to $20,500, because of the low-income tax offset, the tax-free threshold is actually $20,500. That's why it's $20,500, not $18,200. Just explaining. Don't go over your contribution limits because it includes your superannuation guarantee contribution. So what the ideal scenario is, if you are on an income of $115,000, so the maximum amount you could contribute without going over your $35,000 contribution limit is the $24,075. So if you put that over into your superannuation account, that'll save you tax of close to $6,000 per annum. If you're doing that over the next 15 years, 10 or 15 years, that's $60,000 that you're retaining in your pocket instead of paying to the government. And whilst it is fair to pay taxes, it is also a legitimate way to help boost your retirement savings, and then you're less reliant on the government later on. So 2 things. Make sure that it is actually saving tax, and you can go down to that $20,500 if you've got a low enough income. Don't go over your contribution threshold. The other thing is making sure that you've got enough cash flow to afford to salary sacrifice, because basically you're foregoing income into your bank account to put it into super and save the tax. So again, on $111,000, we're salary sacrificing the maximum amount. But if that means that we've got a bit of an income gap, we really need the $111,000 to live on, then the salary sacrifice scenario doesn't work. Now, what you could potentially do is salary sacrifice less. So you could say, well, I could get by on $100,000 and therefore I'll salary sacrifice $15,000 into the super fund, but you are missing out on tax savings of a little over $2,000 by reducing the amount that you salary sacrifice. So if you have reached your preservation age, you could potentially salary sacrifice the maximum amount and then start to draw on your superannuation money in the form of a pension to make up the gap, so to fill that gap. And if you're over 60, that pension amount comes to you fully tax-free. If you're under 60, there is some tax ramifications for it, so you just need to factor that in as well. But this is the key of the transition to retirement strategy. Ken says, will you explain personal deductible contributions as part of the $35,000 limit? Yeah, personal deductible contributions are a concessional contribution. They're only eligible for those people that have generated less than 10% of their total income from employment purposes. This cut sometimes is relevant for those that are self-employed or for people who have retired and sold a large asset, and then they can make personal deductible contributions. So it's putting money into your super fund, claiming a deduction on it so that at 15% tax is deducted, and then it reduces your taxable income. If you want to learn more about that, then tune into the next webinar on the 7th of September or register for that, and we go into that in a bit more detail in that scenario. So how much should I salary sacrifice? Depends on your cash flow, but the transition to retirement strategy can benefit you in that respect.